The tax clock is ticking. April 15th is less than 2 months away. Are you going to pay someone to prepare your taxes, or are you going to give it the old college try and do it yourself? If you are a do-it-yourselfer and know very little about filing that 1040 form, then this might just be the book for you. From the Dummy series comes the 1996 edition of Taxes for Dummies, and joining us now with some helpful tax tips and money-saving strategies is the book's author, David Silverman. Welcome, David.
Thank you for having me in.
Well, what's the first thing that a dummy needs to know about the 1995 taxes?
Well, thankfully, one of the byproducts of gridlock is that there wasn't a massive tax bill this year.
Right.
So everybody would be scratching the back of their head trying to figure out what it all meant. But there were three things that would make life easier for taxpayers. And the first one is you can have your refund deposited directly to your bank account without having to file electronically. This should speed up your refund by about 10 days to 2 weeks, and it'll keep it from getting lost or stolen, which is no small thing, because every year 90,000 refunds are returned by the post office to the IRS. The second thing is the nanny tax. At one time, if you employed someone in your house and you paid them more than $50 in any quarter, you had to file a quarterly return. That's no longer the law. Now you don't have to pay the nanny tax until you pay somebody $1,000. And that babysitter, if she's under 18 or he, for any part of the year, they're exempt from it. And instead of filing quarterly, you file a form at the end of the year and attach it to your tax return. So life is a little bit simpler on that. And with regard to travel and entertainment expenses, for over 30 years the rule was if you incurred an expenditure in that area for over $25, you needed a receipt. Well, it finally dawned on the IRS that there was something called inflation. So they raised that threshold as of last October 1st to $75. So those are three things that should make life a little bit easier for taxpayers this year.
Okay, I've got stacks of yellowing tax records from years ago molding in my closet. How long do I need to keep them?
The general rule is 4 years because there's a 3-year statute of limitation. And you know that rule, there's one extra for the pot when you're making coffee. Right. That's where the extra year comes in. But basically for your 1992 tax return, which was filed April 15, 1993, if the IRS doesn't adjust your tax or audit you by this April 15th, they've missed your chance, so you can throw out everything relating to 1992. However, and there's always a however in taxes.
Always exceptions, yes.
If you bought a stock or made an improvement to your home in 1992 and you throw them out and you don't sell that stock for a couple of years into the future, you're not going to have those records. So the rule is hang on to all records until 4 years after you dispose of the asset. Okay.
When should you use a professional to help you?
Well, as these tax software programs become more and more popular, I'm always asked that question. And I can understand why people are flocking to these software programs. Because if you were my client and I'm sitting across from you and I say to you, well, how much did you spend for, what was your mortgage interest? And I put that in, and what was this? And you're getting back basically data entry. Right. You start thinking, hey, I can do that. And people go out and buy these software programs. But the problem with that is you cut yourself off from good tax advice. So maybe the thing to do is get a software program to do the number crunching, but then get a good tax professional for the brain power, because taxes arise throughout the year. You can have questions with regard to your 401k, for your fringe benefits. There's a whole area of taxes that occur after April 15th.
Good news for those tax professionals out there. Thanks so much, David. It was a pleasure to see you. And in tonight's mutual fund,
use their massive budget bill to remake government by cutting entitlements and giving more discretion to states. They also want to cut taxes.
And we've asked an expert to join us today to discuss what all this may really mean if and when it finally gets to all of us. David Silverman is a tax columnist for Smart Money magazine, and he is the author of Taxes for Dummies. And we often feel like dummies when we're trying to do our taxes.
That's why we pay someone else.
Dave, thank you very much for joining us today.
Good morning.
Good morning. I want to ask first, how good a deal is this for taxpayers?
Well, the bill is a mere 1,900 pages, and it's like a giant Christmas shopping list. There's something in it for everyone. The centerpiece, as you earlier reported, is the $500 family tax credit for each child under the age of 18. That's going to kick in January 1st, and the Tax Foundation estimates that 35% of all households will be affected by this. Basically, this means that starting January 1st, if you're entitled to a $500 credit, you'll see your weekly take-home pay increase by about $9.60.
Will this affect the average family's tax burden?
Yes, it should. Well, it's hard to tell exactly which families, but overall 35% of all households will be affected by this and will have their taxes reduced. As I say, there's something in it for everybody. For senior citizens, there's a rollback on the maximum amount of the Social Security that they have to pay tax on. In 1993, the maximum amount was raised to 85% from 50%. That gets rolled back to 50% over a 4-year period, I believe. There's a second proposal for seniors who continue to work if they're between the ages of 65 and 69, and if they earn over $11,000 a year, they have to give back a portion of their Social Security. That threshold will be raised to $30,000, and for 1996 it'll be $15,000. The marriage penalty gets reduced by $145. The rules on IRAs have been changed to allow what's called a homemaker's deduction for a spouse who doesn't work outside the home, and the thresholds of when you can contribute to an IRA are also increased.
All right, David, you know, we hear this term earned income tax credit bandied about quite a bit in all this. Explain to us what that means.
The earned income tax credit helps lower income folks who earn a modest amount of money to get back part of the Social Security tax that they pay, and it's a refundable credit. And the credit could be as high as, I think, $3,000 this year, and it's depending on your income. And if your income, it starts getting phased out at $23,000 or $26,000, depending whether you're single or married.
Well, you had mentioned that the impact it's going to have on IRAs. What is this going to do for overall savings for retirement? I mean, is this going to be an advantage in the long run?
Well, hopefully. The jury is still out. We're going to have to wait and see. But there's something called the American's Dream Savings Account, which means that you'll be able to put away $2,000 into this type of account, $4,000 if you're married. Now, if you keep the money in there for at least 5 years, when you're 59 and a half, you can withdraw those funds tax-free. So if you put away $2,000 and you were fortunate enough to hit a high-flying stock, and there's now $20,000 in the account, you can draw that out at age 59 and a half tax-free. And first-time home buyers can also tap into this, these funds tax-free. You can also tap into it for college tuition and for medical expenses.
But people are going to be worried about capital gains.
Well, the capital gains tax has been cut by at least 8%. It could be more if your income is down, because under the new rules, half of the gain will be exempt from tax, which will mean the maximum rate will drop from 28% to just a fraction under 20%.
What about for people looking for deductions for home offices? Will the Republican plan accommodate them? That's
correct. Right now, the rules for deducting an office in your home are very tight. For example, if you're a salesman and you spend 30 hours a week calling on customers and only 10 hours a week in your home office, you can't claim a home office deduction because you don't spend most of your time there. Under the provisions in the Act, now that salesman will be able to claim a home office deduction.
If all of this stuff does go through, I mean, we hear a lot about lawmakers saying that they're trying to simplify the tax structure. Do you think that any of this really will simplify things for us as taxpayers?
Not this bill. This bill is a monument to complexity. It's the Wall Street Journal refers to it as the Accountants and Attorneys Full Employment Act.
Well, glad to see that you can.
I'm not complaining. But there's one provision, if we have a moment, that really has to be classified the goofiest provision of all. And I think the House retired the cup with this provision. Because the spending cuts are less than the tax cuts, there's a $10 billion gap. So next year, people will have to compute their tax two ways. You'll compute it the regular way and under the new law. Then you take 27% of the difference, and add that to your tax to compute what your actual tax liability are. Are you still with me?
No, we'll check in with you.
I think we need another book from you, David, on that.
David Silverman, tax columnist for Smart Money Magazine. Thanks for joining us.
My pleasure.